Futures trading involves risk and is not suitable for all investors. Content provided in this segment is meant for educational purposes and is not a solicitation to buy or sell commodities.
Hello, and welcome to Forecast Update Live, a video series from EverAg Insights, where each month we will gather to discuss our dairy market forecast. I'm your host, John Spainhour. We're joined today by Erica Medke, Tracy Mobley, and Phil Plord. To get us started, Erica, please run us through the highlights of this month's forecast compared to last month.
Good morning, John. Thanks for having me back again. The forecast updates, really, our changes are out in 2025, and it's a bit of a tilt as we think about the cheese capacity that's coming and the demand situation we're in right now. We've taken cheese numbers down quite a bit in 2025, an adjustment as we think about the weight of supply. And then the opposite in the butter powder space, we really do feel that butter will be impacted the most in terms of buyers' willingness to pay. And so we've taken our butter forecast numbers for 2025 higher.
Thanks, Erica. Each month, we ask one of our panelists to take either the bull or the bear case in the market outlook. This month, we've asked Tracy to take the bull outlook. Tracy, take it away.
Right. Thanks for having me on this month's forecast update and giving me what I think is the easier side, the bullish side. I think overall, the bullish side centers around tight milk supply. But before I get into the supply situation, hit on demand. Demand hasn't been horrible. Consumers are shifting where they're shopping, but overall, demand is holding up. Domestic use for cheese and butter for year to date is on the positive side. So consumers, while struggling, are hanging in there. On the supply side, a very tight milk situation makes me more bullish for the forecast. We've had 12 consecutive months with negative milk output. And as we ended June down 62,000 cows, it's really hard to see us picking up milk supply. And with milk supply being short most of the year so far, it's really taken a toll on the commodities. So you look at cheese, stocks are down 6%. Same with non-fat dry milk powder, stocks are down 6%. Whey down 20% from last year. So we have a lot less product out there than we did before. Butter, on the other hand, stocks are up 7%, but build season is over. Cream is getting tighter, it's hotter, and all we have to do is wait and watch production decrease month after month on a tight cream supply and wait for Q4 and hope that our anticipated demand meets what stocks we have out there. But there's little incentive to sell the market lower, at least until Q4 is passed for butter. So overall, on all the commodities, I was happy to take the bull case.
Thanks, Tracy. Erica, you've got the bear case this month. Take it away and let us know what you're seeing out there.
You know, John, a lot of our clients want to have a seat at the show when we debate our forecast. And so we'll do it a little bit for everybody today, because I'll take the opposite take on demand, where when I think about demand, I usually think about three different buckets as we think about consumption, whether that is retail, grocery space, food service, and kind of that export, import, international world. As we think about dairy demand in retail grocery, Tracy's right, we've had some pretty solid numbers. I do think those are driven largely by promotions. And so if we see any sort of pullback in promotional activity, which we did see a bit in butter, we're starting to see butter prices now at $5.19 on the national average for scanner prices. I think that dampens demand a bit. As we think about those spaces where cheese is selling, a very large retailer moved their everyday low prices lower earlier this year. They have recently moved them back higher. That's also not good for consumer demand looking ahead. As you think about that retail space, QSRs have really had some battles in terms of promotional activity. I'm not certain that that's really going to move the needle for the dairy space. It seems to be more chicken than cheese in some of these meal deals. So that's, I think, a challenge for the dairy complex to see any sort of lift in the food service. And then on the export side, we got numbers yesterday in terms of cheese exports, for example, and we went from over 100 million pounds in May down to 86 million pounds, which is really close to a baseline level, which to me says we didn't have any deals. We didn't have a price low enough to move any product over the last few months. And that pushes roughly 20 million pounds somewhere it's got to go. Now, we may not feel the weight of it in the cheese market today, but it's here, it's coming, and I think that'll keep some pressure there. On the butter side of things, we do have 7% more butter in storage this year than we did last year. The other thing to note on the import side of things, especially from a fat perspective, year-to-date butterfat imports into the U.S. are up 22%. We're seeing more Chapter 18 fat and cocoa coming into the U.S. While it may not be in the butter market, it does come in terms of fat usage. So I do think there are some cracks in the armor when it comes to demand. The other thing to note, yes, Tracy's right that we need to be concerned about not having a lot of heifers. But one thing I do know about dairy producers is if there's money to be made, they're going to make some milk. And right now, DMC margins, so that's revenue minus feed costs, is the highest it's been since 2015, which says that if there's a way, there's a will, there's a way, they're going to make some milk. It may not be today, but it takes a little while, but we could definitely see some more milk coming online.
Thanks, Erica and Tracy. Those are both great outlooks. Every month, Phil Plord and the Insights team put together what we refer to as our favorite look. Phil, I'm always excited to see what you've got, and this month it looks like you're bringing another great look to the table. Take it away and let us know what you're seeing.
Yeah, this is kind of a fun one. Erica mentioned better margins, and one of the things that's playing into that right now is lower corn prices, down at multi-year lows, kind of around $4 a bushel on the December contract. And the genesis for that is we have a great-looking crop. And it's one thing to drive around, as we are prone to do in our work, I drove to Iowa and I saw nothing but good corn. Windshield agronomy can be dangerous, but the USDA does help us out with weekly crop condition ratings. And while subjective, there's a long history of them. And so one of the things that we want to look at is, what does it tell us when the crop is as good as it is right now at week 30 versus final yields? How much can go wrong at this juncture? So week 30 was a week ago. 68% of the corn crop was in either good or excellent condition. That's on the high side of average. We count 10 years going back to 2000 where we were at 68% or better. In one of those years, yield came in exactly where USDA thought it would on May 1st. So 1 year's a push. In only 2 years did we see final yields come in below the May 1st estimate. The first one was 2020, which is kind of memorable because we had that derecho come across Iowa, flattened a lot of crops. And so that kind of ruined what was a good looking crop at week 30, turned out to be not a great crop because of the high windstorms that came through a swath of Iowa. The other one was 2010, and frankly, I don't remember why. What went wrong in 2010. The other 7 years have all featured yields above the USDA May 1st projection and by an average of 4%. This year, USDA was at 181, which would be a record. And I think that, as we'll see in the WASDE report next week, I'm guessing we're going to see even bigger number come out. It's going to be 182, maybe even higher. And so the point of this is to say, how secure can we be in the notion that corn crop is going to be good based on where it stands in mid-July? And history says, absent a freak windstorm, things are in pretty darn good shape, which would accrue to lower feed costs for dairy producers nationally. So kind of a fun one. It does seem to matter that if the crop is looking good at week 30, it tends to finish well.
And if I'm not mistaken, Phil, it's not just the spot, but the futures markets are also suggesting.
We're just seeing a deterioration in prices. The kind of crop that we're looking at, history says $3.75 to $4 a bushel kind of crop. We're not there yet, but I would say, the further we go, those numbers kind of get closer to the center of the table.
Thanks, Phil. Again, always just incredible work that you guys bring to the table. That'll do it for this month's episode of Forecast Update Live. Thank you to our panelists. Thank you to everyone on the EverAg Insights team for their work on the forecast. And thank you, the viewers, for tuning in. If you don't receive our forecast update and would like to subscribe, please reach out via email at insights@ever.ag. If you like this video, be sure to subscribe to our YouTube channel, give us a thumbs up, and share us with a friend. We'll see you next month for another edition of Forecast Update Live.